Hello. We're going to be looking at how to enter a rental property. And you can see right here, rental and royalties, Schedule E. You can also find that down here under rentals, royalties, and farm, rental properties and royalties, Schedule E. Did you have any income from rentals or royalties? Yes, I did. And then you can select if it's a royalty or a rental. We're going to go ahead and do rental since that's much more common. And we'll just call it test 123 main. And we're going to skip putting, oh, will it let me skip putting the address? No, it will not. All right. And single family home, multifamily home, vacation or short term rental, or just land. This means land without a structure. So, vacation or short term rental, careful with this one because it may be a Schedule C instead of a Schedule E. And that's a very complex topic on which one it's supposed to be under certain circumstances. And there is no clean cut guideline. It's more just on a balance of bunch of different factors. And if there's more factors leaning towards Schedule E, then it would be a Schedule E. And if there's more factors leaning towards Schedule C, then you might want to consider doing a Schedule E. So consult with your tax professional. Single family home, that's going to be the most common. So we'll go ahead and proceed with that scenario. If this was the first year, if it was sold or disposed of, if you converted home to rental or rental to home or rented out part of your home. So this is if you have a bedroom you're renting out or anything like that. This is if you were living in the home and then bought another home and decided to turn your previous home into a rental property, sold or disposed of, or first year rented. You can select none of these and just go and continue if none of them apply. Was it rented every single day in 2024? Let's go ahead and say yes. Yes, it was always rented at a fair price. No, it wasn't sometimes. So this does get into a little bit of explanation here. Fair days rented, if it was rented or available for rent, fair rented days is still going to be 365. And since we're talking about 2024, it's actually going to be 366 since it was a leap year and zero personal days. The IRS has a 14-day rule where if you used it personally for 14 days or less, then you do not have to report that. It does not prorate any of your expenses. You can count it as zero. This is for a rental property. On your personal home, you can rent out your personal home for up to 14 days, and that is actually non taxable income. Very, very rare to hear those words from the IRS code of non taxable income. So fair days rented 366. In this case, that would just be yes, it always was. But let's say that you were living in it in part of the year or something along those lines, and you would calculate from there of how many days it was. But the moment you move out and you begin an intention of profit, even if it wasn't rented yet, and you moved out and you started remodeling with the intention to rent, that is going to be included in the fair rented days. And just to really hammer this point home, let's say it's a full-time rental and you never lived in it or anything along those lines. You had a month of downtime. You lost the tenant, and by the time you found a new tenant, a month had gone by. That does not count against you. That would still be considered fair days rented for the entire year. And are you an active participant? This is typically going to be a resounding yes. You own at least 10% of the property and you made major management decisions such as approving tenants and authorizing repair. That's going to be 99.9% of landlords. Did you make any of these payments? Paid a contractor $600 or more to work for me, made payments that require me to send a 1099 form. So these are ones to watch out for because a lot of people think that they're supposed to issue a 1099 form for anybody who comes and does work for them. That is not always the case. If somebody has done a service for me, if I have a gardener who has their own gardening business and they show up and they do my landscaping and they do the maintenance and all that, that is not considered my contractor. That is not my employee. That is not, it, he has his own business. I do not need to issue a 1099 to that person. That person needs to give me an invoice, which then I will deduct as an expense on my tax return. So we'll go ahead and say no for now. I was not the only owner of this rental. My property is on an Indian reservation or disaster area. And if this is your spouse that you co own it with, this does not matter. You are one entity for tax purposes. Okay, and this is just a summary page of everything that we've done so far. Now it's going to ask us about our income. I'm going to put something in here just so we can see how this all behaves. Let's say I had $10,000 of rental income. You can see my tax bill shot up immediately. Let's say no, I don't have any more income. And expenses and assets. So you can see the rental property comes pre-checked, and there's a reason for that because you are choosing depreciable assets here of what you want to enter. And the rental property, the structure itself, is always considered a depreciable asset. Now, there are scenarios where you may not want to or may not care to depreciate the property, but again, 99.999% of people, there is no benefit in not depreciating the property, and there's tons of disadvantages to skipping it. So you really want to leave that one checked and enter. We'll circle back to that in a moment here, and then enter any other expenses that are applicable. So real estate expenses or real estate taxes, that's going to be almost everybody. Insurance premiums, that's pretty universal. Repairs, cleaning, maintenance, mortgage interest, these are all going to be very common. Utilities is a little less common depending on who's paying for the utilities on the property. Sometimes it's in the landlord's name, sometimes it's in the tenant name. Then we start getting into less common things. Management fees depends on how you're set up. Professional legal fees, you might have some. Advertising, commissions. So there are a lot of different categories here. And if you have an expense that doesn't fit neatly into one, you can always check that miscellaneous expenses. And it's asking us about the repairs that we selected because I did select the repair category. Now, there are some very specific rules on what is a repair and what is an improvement. A repair can be deducted as an expense for this year. So if I spent $1,000 on something, it's going to let me go ahead and deduct that $1,000 this year. If something is considered an asset, that has every asset category has a different lifespan. So, for example, for the rental property itself, the structure is considered to have a lifespan of 27 and a half years, and that's the time that it depreciates over. Every different asset has a different lifespan, every category has a different lifespan. So depending on what it is, it will depreciate over X number of years. Now, if something is considered an improvement, you must claim it as an asset and depreciate it over time. If something is considered an expense, you can take 100% of that expense this year, no questions asked. Now, if something is technically considered an improvement by definition, but it costs less than $2,500, you may claim it as an expense, and vice versa. If something would typically be considered a repair, but it cost you over $2,500, you may have to look at considering it an improvement and claiming it not as an improvement, but as an asset. So, for example, if I have a chain link fence on the property and that fell down and I had to replace over $2,500 worth of expense to replace that chain link fence, that's not technically an improvement because an improvement would be if I replaced it with a stone wall. But the fact that it's over $2,500, that might be need to be considered as a new asset that will then depreciate over time. So we'll just go ahead and say it's a repair for now. And you can see this functions very similarly to a Schedule C. You just come in here, you put in the amount, and that's it. Let's say I spent $5,000 on real estate taxes as my property tax bill, and that's it. Just one line item, and these all exactly the same. Just put in the total amount for that category, and that's it. Now let's talk about the rental property and assets. So under the assets section, we want to take a look at this rental property. And this is going to be rental real estate. This is the structure itself that we are depreciating here. And residential real estate again, you can see land improvements, appliance, carpet, furniture. That's just under the rental asset. And then here you have a lot of other things that you might depreciate. But for now, we're just doing the structure. Describe it. This is just 1, 2, 3 main. The cost, this is how much you paid for it. And you can see here it says represents your ownership percentage. So let's say the price tag on the property, if you owned this with somebody else that is not your spouse, and the property cost 500,000, then I paid half. That would be 250,000. That's what I'm going to put here as my cost. But let's just assume I own this with my partner and we paid 500,000 for it. Cost of the land. This is very, very important because the cost of the land, that is non-depreciable. So my depreciable amount is the total cost minus the cost of the land. That then gives me my depreciable amount. The land is never considered to depreciate. It is just the structure that depreciates over time. And let's go ahead and put in the date acquired. I'm just going to put January 1st, 2020, so that it has a little bit of history to it. And tell us more about it. I traded an old asset to acquire this one. You can see it says this is not common. I purchased this. This is going to be most people. You purchased it. And I've always used it for 100% of business. If that's not true, then you just say no. And then you just select whichever one applies to your situation, the date I started using it as a business, and the percentage of the item that is used for business after it was placed into service. Just to keep it simple, we're just going to say, yeah, I used it for the whole time. And the date you first started using it, I'm going to go ahead and put in that same purchase date because I've been using it as a rental since the moment I bought it. And there we go. So you can see this is not the depreciation it added on, but it did add on depreciation, which then reduced my tax bill significantly here. And we can check this show details. So 27 and a half years, that's considered to be the lifespan of the structure. Our cost basis minus the land, that's what our depreciable amount gave us. And this is the rest of it's just a summary. And there we go. And this is the depreciation for this year, 14,545, and done. And that's all you need to know as far as the basics of rentals. But it does escalate in difficulty from there. This was just the most basic of scenarios.